Welcome back, everyone, to Vox Markets. My name is Paul Hull, and by popular demand, I'm delighted again to be able to speak to Paul Scott of Stockopedia, one of the UK's finest small and micro cap investors. So welcome, Paul.
Thanks, Paul. I don't know about being one of the finest investors. It doesn't feel like it this year. I think I said that last time we spoke, but I like doing the analysis. That's the stuff.
Yeah, well, no, you're pretty good at it. I mean, and let's kick off with a. Let's kick off with a top level sort of like questions, because I mean, obviously it's Halloween and the markets have been pretty spooked by all of the interest rates, rising inflation, and the ongoing war in Ukraine. So, sort of top level, what's your sort of like view for your sort of sweet spot of small and micro caps?
Well, I'm super bullish on the individual company valuations. I think you and I might have discussed this before. I can, if you totally put the macro picture out of your mind, just looking at individual company valuations, I'm coming off every day. I'm finding things that I'm looking at them and saying that's a 2 or 3 bagger once the economy has normalized. And so the valuations now, I think, are incredibly attractive. But the big problem is the PMIs are all now pointing towards recession. You've got the Bank of England and the Fed, I think, making terrible policy errors, stopping QE and letting interest rates rise too fast and too far. And you've had multiple crashes in entire sectors like bonds, equities, property, even crypto. And I don't see how that can end well when you have such a vast amount of wealth destruction in such a short space of time. So at individual company level, I'm super bullish, but macro, I'm pretty terrified really about where things are going.
Yeah, there's quite a few actually small caps who think that, or small cap in fund managers who believe the sort of small and micro cap sort of stocks are a bit like a coiled spring, and they're just waiting for the right trigger to be able to really sort of like, because they've been hit the hardest. And usually they're the first to come out of, sort of like difficulties. Now, there's one stock that I know you've been buying recently. You've done a bit of sort of like blind or mystery shopping, which is XP Factory, and I've seen that. And I think I'm not sure you did. I don't know whether you managed to sort of interview the CEO, but I've certainly seen some sort of like your pictures going around Bournemouth. Do you want to take me through sort of like what's sort of piqued your interest on XP Factory? Because I think they own the Boom Battle Bars and I can't remember what was it? Escape Hunt, yeah.
Yeah, well, I followed it for years since it listed. It was originally just Escape Hunt, didn't really work, and they only had about 8 sites. Then the pandemic happened, and of course, there's nothing worse than being put in a small confined space. So, but it's really reinvented itself more recently. And you've covered, I know you did I think it was either you or Justin did a really, really good interview with Richard Harper.
Yes, it'd be Justin because I think he likes it like you do.
Yeah, he did a very, very good interview. Now, coincidentally, I had an interview booked for Richard the following day where I'd approached him and said, look, I think this is an interesting share. So I don't do commercial interviews. I just I choose the companies I want to talk to because I think the shares are the most interesting. So it's a very, very interesting format. And in a nutshell, they're exploding in terms of growth, and they should be up to about 50 sites by the end of this year. A lot of them are franchised, so they can roll them out very, very fast. And they're getting sensational deals on the sites. So typical economics of the Boom Battle Bar sites are about an 800 grand fit out. 500 grand of that comes in a capital contribution from the landlord. So the net cost of opening the site is only 300k, and it pays back in 1 year.
Wow.
Those are remarkable economics, although we are having to rely on Richard's word for this. The problem with any, startup effectively is that you haven't got historic numbers that prove the case. So, but he strikes me as a very straightforward chap, very good strategic thinker. I think he's really impressive what he's achieved there.
Well, if you had a bit of spare time, you could become one of their franchisees, couldn't you, and test that to make sure their financials model. Now, the only question I think the investors would have is the longevity of sort of like competitive socializing or entertainment, because we've obviously seen things like Laser Quest and paintballing, which have had their sort of like sun, and they continue. They're still doing fine, but they're not as high, sort of like as popular as they were. What's? I mean, obviously you've kicked the tires on this and you enjoy it, but what sort of like longevity do you think the sort of business model Boom Battle Bars and Escape Hunt have?
Well, I don't know because we're guessing really. But when I
Mm,
asked Richard, the CEO, the same question, he said, "Well, the escape hunt sites, which have I think between 4 and 6 different themed rooms,"
mm,
he said we haven't refreshed any of them. They've been there for 5 years, and he said it's a low density model, to use his words, where you only need about 80 people a day.
mm.
And the reality is that because of people move, say in a town like, I don't know, Bournemouth, about 250,000 people, people are coming and going, young people are growing up and so on. You'll have a continuous churn of customers, he reckons. And the Boom Battle Bars thing, it's not a single themed thing like Crazy Golf or as you say, Laser Cluster. It's lots of different things. So they've got a karaoke room. They've got the enhanced reality darts was very, very good. And all these things are modular, so they can be taken out and moved around and replaced. And they've got their own creative team coming up with it. All I would say to people who are skeptical is just go and visit one.
Mm.
And what struck me is it really feels different to any other type of bar because everybody's happy and doing things, and the staff are just buzzing. It's not just standing around talking.
Yeah.
It's just got a totally different vibe to any other bar I've been to. So I think it's worth looking at.
Yeah, no, you've definitely piqued my interest. I might well take my kids there over Christmas to throw a few axes and just put up my portfolio.
Yeah, I think it's adults only after about 7 p.m, something like that. But
okay, well, I'll go before then. Now, on a couple of things which have sort of run your winners, you've obviously, we talked about before, was Beeks Financial, which does sort of is a cloud provider for, I think it's high frequency trading of sort of like hedge funds and banks and stuff like that. You'll take us through that one, because that seems to be still knocking the ball out the park. It's not cheap, but it's still doing really well.
You're right. It's not cheap. I think the market cap's 95 million currently. And it's one of these things that, they're just reinvesting all the time, growing the thing. So it's not something where you can say, oh, well, the PE is this, it's cheap, It's but I think if you look at the rate of growth of recurring revenues, and this is all long-term, contracted revenues, they're growing it now almost exponentially, and they've got a tremendously strong pipeline now, and they've just done a deal with the biggest global exchange, the people who own New York Stock Exchange, and they're basically saying, if you believe the CEO, he's saying they've got all these major deals in the pipeline. We don't know when they'll land, because it's a 2-3 year gestation period for these big deals, but he says we're well advanced on other similar deals. So I think that looks very nicely set up. But like you say, it's not cheap. But I'm just gonna run with that, because it does seem, I can't really think of anything else on the market that's got those characteristics. It must growth, all organic.
And it must have high EBITDA drop-through rates, because every pound of extra turnover, because if you've got the fixed infrastructure, then it just I don't know, 80-90% of it drops down to the bottom line.
I don't think it's quite that high. I think it's nearer 50 or thereabouts, because they do have to pay fees to the exchanges, and they rent rack space if you suddenly need to put in loads more racks of servers for a new client. So some of the costs will go up. But I mean, the other thing is that it sounds as if they're undercharging a lot of their customers as well. I think there's considerable pricing power. Once you're in with a major financial organisation, and it works. He said it's taken them 10 years to get where they are, where big banks will actually start entertaining using this cloud service because it's business critical. I think to just have a look at the webinars that the CEO's done, and he founded the business and he's the major shareholder. I think it's a very interesting story, but we don't know how it'll pan out, but everything's looking good, I think, on Beeks. Yeah.
Another one which you've been following for some time is Sosandar, the sort of like ladies wear retailer, online retailer that has gone through sort of like a mixed patch, but actually has really picked up, hasn't it, of late? Do you want to take us through that one?
Yeah, I don't currently hold that one because I've just dumped both of my geared accounts because it was just becoming too painful. But I am looking to go back into Sosandar, the ticker's SOS. That's another one that's achieving absolutely stellar organic growth. And there are some quite important drivers behind that, like, for example, partnerships with Next, Marks and Spencer's, Very Group, and I think two others, John Lewis, and they're only selling quite small capsule ranges. So and they sell very, very well through these third-party websites with very good margins as well. And it's a lovely scalable business model. And the point of difference is the product. It's the two ladies who run it, Ali and Julie, who come from a fashion magazine background. And they've absolutely proven the business model now that they're doing something different and something unique, which allows them to achieve high margins. They've outsourced everything. They haven't got all the logistics. Everything's outsourced. So they can just scale this thing up. And then, of course, there'll be international growth. So I think Sosandar is looking really exciting now. So I'm really straining at the leash to get back into that one.
Yeah, well, you were a big fan, weren't you? You bought a lot at about 10p at one stage. So wasn't it? About 3 or 4 years ago, maybe 5 or 6 years ago. I can't remember.
It's something like that. I mean, it came to the market literally as a startup, hardly any revenues, and they've achieved what they set out to achieve. They've grown it now to something like 40 or 50 million revenues. It's now profitable. But the interesting thing is it floated at 15p when it had all the hype and the premium valuation. It then did a load of placings, so it diluted because it kept running out of cash. And the share price now that they've actually built a substantial business that's now profitable, it's only 19p. So the trouble is, I think, yes, even though I was right about the business model, it just shows, doesn't it, that one of these jam tomorrow things actually does work. You still don't make much money on it.
Well, at the moment, you might find when it does scale and go big time international, then you get about a lot of leverage coming through.
Yeah, well, I think risk reward now is the best it's ever been by far. But of course, now that we're deep in a bear market, nobody's interested. So
yeah. So what stocks do you own now then, as in like in your portfolio? So you've got
not very many actually. I had a complete cull because I thought, well, you know, when the losses are multiplied 4 or 5 times through a spread betting account, I just had to draw a line under it and say, look, I can't take any more losses.
So you've given the keys back, have you, on your spread betting, have you?
I've renounced gearing probably 20 years later than I should have done. But, you know, as I've always say on these interviews, Paul, I'm just an enthusiastic commentator. I love doing the analysis. I'm a terrible investor. I mean, I make good money most years, let's be fair, but I always seem to give it back because I've got the wrong personality for managing money.
Right. Okay.
It's good to know yourself and accept.
Yeah. I would agree. No, you need to basically look at yourself objectively because it's only that you can then control your sort of your investing. So then how much cash have you got? Quite a lot of big cash holding at the moment then, or is it just
not really? No, I'm pretty much fully invested in physical shares. So
okay.
Because then I can just relax and I don't have to worry about, and I don't really care what the share price does if I feel that it's something I'm happy with. So Beeks is one of my biggest positions. Cambridge Cognition.
Let's go for Cambridge then. So that was another one which is run, because I know you mentioned to me a couple of times, and again that's done really sort of well. It does sort of like neuro testing, I think, for sort of like trials and clinical data, basically for Alzheimer's and dementia, doesn't it? It tests patients, I think.
Yeah, and they're opening up into other areas. I really don't particularly understand that area of it, but it's got a big moat around it, this business, Cambridge Cognition, because they got sort of decades of data that you couldn't just replicate overnight. And I think there's only really one serious competitor, and that's based in Australia. And the nice thing about it, it's not affected by macro or consumer conditions. So Cambridge Cognition, you know, they just keep winning contracts. The order book is growing. Cash pile keeps growing because they get a certain amount of cash up front, so you don't have to worry about dilution. The only thing is, it's kind of operating around break even. It's one of those growth companies where they always seem to find something else to spend the money on when they, you know, you always see these forecasts, don't you, showing exponential profits. And it never happens because they find the staff need paying more, and you know, let's get an assistant for so and so. But no, I think just to tuck away and forget, I still really like Cambridge Cognition. The story hasn't changed at all, and the shares seem to find a level about £1.20 where there are no sellers at that level. And
I would have thought it'd be an ideal takeover for sort of like probably a life sciences type of business, or even a sort of contract research organization to bolt on a high value. You could take out all the operating costs and just run it off the gross margin, which would be high for that kind of, high value product, I guess.
Yeah, it's about 80% the gross margin, so it has got nice operational gearing. And of course, given that we're in a bear market, these sorts of growth companies that are still performing well are about a third the price that they were a year ago or 18 months ago.
Yeah,
So,
you raise a good point, because it's sort of two big areas of opportunities in small caps. Not only the undervalued shares, which are primed for a recovery, obviously in the retail and online and leisure and stuff like that, but also GARP stocks, because they are being used as a source of funds a lot of the time for people to basically check out of and to make them feel better, but create a bit of cash so they could, sort of like have some funds from another source.
Yeah, I think you're absolutely right, Paul. I mean, a lot of the selling is not rational selling at all, is it?
No, it isn't. No,
they're frightened, and as you say, want to raise cash for something else.
And one stock which again has done pretty well, which I think you own, is Begbies Traynor, which is basically a insolvency practitioner. That's 75% of the business, and I think it does also some M&A and a bit of property services as well. But obviously, if the economy is now sort of like going through a dodgy patch, and you've got a backlog of potential corporate insolvencies coming through, these guys are going to do pretty well, I guess.
Yeah, I mean, they've got a good several years nailed on now, haven't they? For exactly the reasons you say. So the shares were doing quite nicely. So I don't know really why it peaked recently at about £1.50 and slipped back to about £1.20 or £1.30. That doesn't make sense to me. I don't currently hold this one, but I think, if you think we're really going into a recession, which is now looking pretty certain, isn't it? I think this is a good safe haven. Yeah, and it pays a divvy. The only thing I would say is that Graham and I, from Graham Neary, my colleague at Stockopedia, doing the small cap value reports, we had a Zoom with that was when Zoom actually did work on my computer. I've driven Paul mad for about 20 minutes trying to restart my laptop before we did this, and I had a slight hissy fit and a sense of humour failure as well, so apologies again, Paul. So what were we saying? Begbies. Oh yeah, we had a Zoom with him about this thing of what's it called? You might know, something deemed remuneration.
No, I've not heard. Is this with Rick Traynor, the guy who owns it?
No, it's where they do acquisitions of businesses which have a partnership structure, I think.
Right.
And the accounting rules are really arcane on this. And we had about 40 minutes with the CFO of Begbies. And as you know, I used to be a CFO myself. And at the end of the call, he showed us some slides that he prepared, but so many people asked him about it. And at the end of the call, he said, "Now, is everything clear?" And I said, "No, I still don't understand it."
Okay, so there's a bit of research there on the accounting.
Yeah, so if any of your listeners can work out what the hell this deemed remuneration stuff is, get them on and they can explain it to us.
Yeah.
So the upshot is you have to rely on the adjusted EPS with Begbies, because the statutory figures show it not really making anything. So you do need to be sure that you're comfortable with that, I think.
Yeah, well, that's quite a few times, actually. I mean, I think as long as it's justified between ongoing, underlying and continuing operations, which is your adjusted compared to your statutory, then I'm comfortable with it. But it's when effectively there's always a difference, and it becomes there's continual costs under the line which shouldn't really be there. But anyways,
you're absolutely right, Paul. I mean, Graham looked at Kinnan Carter recently, where he just said, "Look, these adjustments are just ludicrous. It's every year, and it's." All the profits disappear at the statutory level, and you think, no, this is
crazy. Now, one company which obviously it was one of your babies about 15 years ago, which went zooming up and then a zoom down, is Boohoo, that we both own. And I think we've both lost a lot of money, and we're holding because. So you'll take us through what's your latest on Boohoo?
Well, this is our sort of self-flagellation section, isn't it?
Oh God, yeah.
Yeah. Well, look, I mean. The earnings have collapsed, so we can't argue that the share price fall is spurious. It's down 90%. So are the competitors. ASOS is down 90%. In fact, practically all of the e-commerce shares that floated in 2021 are down 80-90%. So these are big sector moves. what I got wrong, well, there's a whole list of things really I got wrong, but the key one, I suppose, is not realizing just how significant the pandemic lockdown boost was for these companies. And then, of course, they've had a lot of supply chain problems as well, which, when you're operating on quite thin margins, has really done a lot of damage. And loads of competitors have gone bust. I mean, Mike Ashley's rescued Misguided. I saw it first, which was set up by Boohoo, Mahmood's brother, Jalal, and then what were the other ones? There've been a few of these.
There's been a number of retail blow-ups, no doubt about it. In that,
yeah, but I think that, look, Boohoo's balance sheet is okay. The only question mark I've got is who is the lender. It's borrowed, I think, gross debt of 300 and something million, and it's got almost the same amount in gross cash. But I've been through the annual reports, I've been through the RNSs. There's no mention of who the lender is. So who has lent Boohoo this money, and what terms is the debt actually on? I'd like to know that. Yeah,
no, I'll have a look at that, because I haven't sort of like, put my sort of like eye as closely at the accounts on that one. It'll be in the notes, but it should be in the notes, you'd have thought.
No, there's nothing. Absolutely nothing. I've been through it, as I say, annual report and all the RNSs. So it wouldn't surprise me if it's the family.
Yeah.
To it. But I would like to know. And I think the thing is, they're automating the warehouses. They've got a lot of startup costs for the new brands that they acquired, a whole load of them in one go. So they're just about to open a DHL, I think, are going to operate it for them.
Yes, they are, in the States, Pennsylvania, isn't it?
So I think Boohoo is fixing all the stuff that needs fixing. And you've also got supply chains now are beginning to, I wouldn't say normalize, but they're moving in the right direction. Yes, the dollar's very strong, but you see the factory gate prices allow for that. Do you see what I mean? So they convert. So the jeans that Boohoo would have paid $10 for, they're now saying, "Well, we'll pay $9 for them," because the factory in China, their currency's depreciated against the dollar as well. So I think you might see margins start to improve on some of these companies, and I think the whole sector now is really oversold, e-commerce. So
yeah, I'm with you. And also the other thing to note was that when Facebook reported its results last week, it did say advertising costs on a like-for-like basis were down 18% year on year.
Oh, how interesting!
Which is a big help for online digital sort of retailers, because
that's a great point, actually. Yeah.
So that should certainly sort of boost things. And as you say, once they've got that warehouse in the States, given how that country was doing really well for it 2 years ago, you could see that becoming by far and away the largest and fastest growing sort of like region.
Because I mean, their key advantage has got to be fast delivery. The customers want it next day, because if they're not bothered about fast delivery and they just want cheapness, they go to Shein, this Chinese thing. But then you've got to wait 2 weeks for the parcel. And the whole point with the young customer, they want something to go out clubbing with tomorrow, I think the other thing with Sosandar, going back to that one, is that a key point of difference, a key advantage I think they've got, is that so much of their business, I think it's maybe up to 3/4 of it, is repeat customers. So that means Sosandar doesn't have to worry about online marketing costs, which is what's killed so many of their competitors, because they communicate with their existing customers by email, and the customers are loyal. So that, I think, is a unique thing about Sosandar that makes them much, much more competitive.
And the other thing which has been sort of like trouble in Boohoo, I think, is the returns, because it obviously exploded. Yes. And I suspect actually they'll get that sorted. They'll bring that down, and if they can do that, and the advertising costs, and they get the logistics sorted out, I'm hopeful, like you, in 2 to 3 years' time, it'll be a different business. If it's not a different, I mean, it was doing, I think, about 8% EBIT or 10% EBITDA margins, and even at the moment, I mean, on forecast, it's 4.3% EBITDA margins, and it's still trading at sort of like 7 to 8 times EBITDA, which is frankly for a quality branded business is dirt cheap, isn't it? If they can get that right, the economics back to where it was.
Yeah, you're right. I agree. The CEO, the founder, Mahmood Kamani, he said on he's a man of few words on webinars, but he said, look, all the issues that have hit the business in the last year or two, we're dealing with them. We're dealing with everything. And so I think they will, I think it's very likely that Boohoo not only is one of the few remaining businesses standing in this fast fashion area. But I think they'll get at least some recovery in margins. Maybe 10% EBITDA has gone for good. I don't know.
Yeah. Well, we hope so for both you and me, because we've lost a lot of money on it, no doubt about it.
Well, I'll never get it back because I've only got a small position now. You know.
Oh, have you? Oh, okay. Well, I haven't sold any, but I've lost a lot, so that's another one. Now, Sanderson Design is a sort of soft furnishing business. Now, I don't know whether this sort of like used to compete against the old sort of like Laura Ashley type business. I don't know whether
possibly. Yeah, SDG is the ticker.
Yeah.
Now, I did a CEO interview with Lisa Montague quite recently. And my Stockopedia and the podcast listeners absolutely loved it. She's such a intelligent and businesslike leader. You can really
like you, Paul.
She's turning this thing around very, very well. Obviously, they've got headwinds because it's high-end soft furnishings and wallpapers, which is not going to be doing great at the moment. But the licensing side of the business seems to be doing well. And she's got big expansion plans for the US. So if people want to have a listen to my podcast on that, I think it's one of the most fun and interesting interviews I've ever done with a CEO. And I think a lot of it is about backing the management, isn't it?
Yeah, it is, yeah.
I'm sure you find the same thing with the stuff you do, Paul.
Yeah, no, if you can trust management, then you do a few sort of like channel checks yourself or due diligence through the numbers, and you get comfortable with it. And then you can effectively, it just reduces the risk, doesn't it? So it gives you a lot more sort of confidence. Not that I get it right all the time, that's for sure, because there's been plenty where I've thought the management's great, but actually they just haven't delivered. So
I know. Same here. But the thing is, I normally find I get one or two shares in a typical year that mop up all the mistakes and everything else. Now,
except this year,
yeah. I'd need a bailout from the IMF to recoup my losses this year.
It's been awful, absolutely terrible.
It happens, and I think it's good to just, be honest about it, rather than these people you follow on Twitter who never seem to make a mistake on anything. They've always sold at the top, and they've always bought it. It's a load of rubbish. I think let's just enjoy the pain collectively.
Yeah, and I think you raise a really, really good point. If you're going to be a long-term successful investor, you need to have a few hard knocks to keep on getting better and to be able to control your emotions and to make rational decisions. You've just got to accept if you're a crybaby, you shouldn't be flipping in the market. Full stop. Yeah, but if you want to get good, you just got to accept that a third of your investments or whatever percentage it is are not going to make you money, and hopefully the 2/3 are. So you've got to be. Always you are wrong, because there's going to be something in your portfolio that's not working, and in certain years you have all. I mean, let's be clear about it. When you and I were investing in 2007, 2008, in the great financial crisis, we got taken to the woodshed. I mean, we got absolutely flattened.
Yeah. No, you're right. I agree with all of that, Paul. That's very
now, one company, I don't know whether you own still, but you've talked about it before, is Saga. Because, I mean, that's obviously a sort of like all things to sort of baby boomers and the older generation, selling them insurance and cruise holidays and travel insurance and all this sort of stuff. And I think actually it's struggled a bit because it's got quite a lot of debt, hasn't it?
It has. I mean, the recovery, the turnaround potential there is painfully slow. So it hasn't panned out as originally hoped. And, the broker forecasts have just been continuously reduced. But it is still profitable and the cash generation is good. The debt, I've been through it all in a lot of detail. The bulk of it is secured on these two cruise ships, which are really new. So that's ring fenced. It's just asset funding like HP on your car. That's not a problem. They've started. They got a leniency from the lender throughout COVID, and they're now, they've now resumed payments of capital and interest. So that's fine. Then they got two bonds. Now this is really interesting because I've probably similar to yourself, I've noticed that corporate bonds, are now, for the first time in 12 years, paying really rather good yields. So I interviewed a bond specialist called Paul Hawkins, who's an absolute star, and we did that interview about a week ago. So I've started looking at the bonds, and Saga, unusually for a 120 million market cap company, has got two bonds which are currently an issue.
Okay.
Now, for wealthier investors, I would
They're
say
tradable securities, are they? They're on
tradable. Yeah, the
Okay.
minimum clip is £100,000 worth, but the 2026 bond, there are two. There's a 2024 one which is smaller. That's trading at about 85 pence in the pound. But the 2026 bond is trading at 65 pence in the pound. So if you hold to maturity, which is about 3.5 years, and assuming it pays it off and doesn't default, you'll get a 35 points, which is about 50% tax-free capital gain. Plus, you'll get a running yield of about 8% on top.
Wow.
Yeah, so the yield to maturity on it's nearly 20%. So
that sounds default country to me.
Oh yes, no, it's priced to default, but there's no realistic reason to suggest it will, because 2026 is quite a long time. It's generating cash. It's already got more than enough cash in the bank to pay off the first bond in full. So that one's trading about 85p in the pound. The 2024.
Has it got any secured bank debt though? Because if you look at the covenants,
no, it's got a 50 million RCF, but they've not drawn down at all on this. And
okay, so they've just got the two bonds.
Yeah, and the covenants in the RCF are mirrored in the bonds, which I didn't know. So Paul Hawkins explained that to me. That's something I previously got wrong. So it just shows, you do need to take expert advice on these things. But I think generally it's really piqued my interest at looking into bonds.
Yeah, I would agree. Yeah, I mean,
you can get a 7 or 8% pretty secure yield without any of the equity risk on big name companies. Which, if you think inflation is going to drop back down again next year or the year after, this could be a good time to lock in some yields. But if you think inflation is going to get worse and worse, then obviously bonds would be a bad place to invest, wouldn't they? I mean, do you ever buy bonds, Paul?
I have done, and I've done okay for the exact reason, because effectively the capital gain is tax-free on the actual bond, but they are flipping high risk. I mean, just the one on the two bonds, well, effectively, if you look at the covenants for Saga and strip out the ship funding, I think they're on about 3.7 to EBITDA, and their limit on their two covenants is 3.75. So they only need a downtrade in their insurance business to breach those covenants, which it sounds though it's just the bond, but I don't. If they've got anything there which is secured, then they've got it's a strong. But we'll wait and see. All I would say is that I could understand why it's 12-20%. Sort of a yield to maturity, particularly when you look at it. When you look at it, Carnival Cruises issued a bond which was a 5-year at 11% only 2 weeks ago, and they are mega big shipping business.
Yeah, I mean, back in COVID, I remember the big cruise lines were issuing bonds on about 18% initial yield, weren't they? So, I mean, God, those would have been amazing deals because, of course, you rank ahead of equity. I mean, the argument, I suppose, with Saga is that Sir Roger Dahan, who cornerstoned the equity placing, is the founder's son, and he ran it himself for 20-odd years. Now, I cannot see him just sitting back and watching this thing default and go bust. He's going to, the risk is to equity, I would say, because if it gets into trouble, they have to do another placing, whereas the bondholders don't have to worry about dilution risk. So that's why I think
all I would say, it's geared. I mean, you just got to look at
it. Is. Yeah,
you just got to look. You've got to look at the market cap at 120 mil. And then you look at the net debt. Let's include the whole shipping, which is 720. I mean, that ratio is pretty lopsided. So you only need a deterioration. Let's just say, for instance, there's a problem with the ships; they get delayed, or alternatively, the insurance business has another problem. Then, frankly, yes, you lose the equity, but actually, you're going to lose some bond value in there as well, and that's what that priced is. It's telling you. But I'm with you.
I mean, I'm not going to argue with you that it is geared. Yes, so if something went seriously wrong with trading, I agree with you.
But I would say the broader point you raise is brilliant, because we've had for the last 4 or 5 years the Tina economy, where there's just no other alternative. Well, there is one now. It is the bond market,
you're right.
And you can get top level gilts or treasuries at 4% or even 5% in certain places, and but you can get sort of investment grade corporate debt six and a half, 7%, which
Yeah.
isn't going to. It's very, very unlikely. And if you have that as part of a balanced portfolio,
Yes.
then I think. I mean, I can't see you and I loading up on debt because we like equities too much. But as part, just to be able to sleep at night, you might find the 60-40 portfolio weighting works okay.
Yeah, I think so. I mean, I would consider, holding some of the Saga bonds and some of the equity. I don't think it's either or.
You got to spare 100 grand, have you, to buy a clip?
Well, it's 65 grand, isn't it? Because
okay, loose change,
which is not out of the question. So yeah.
No. I'm just pulling your leg. No, exactly right. Now, another one which has been through the runner is Hostmore, which does Fridays, the franchise, and they were really well placed because that's sort of like an iconic brand that I used to go in. I mean, when they had their first restaurant in Birmingham, I remember going to Hagley Road and loving it because they were throwing sort of like, drinks around the place and mixing cocktails, and it was great. But they've sort of like had a bit of a hiccup. It looked as though tightening consumer belts has hit them hard.
It has. And I mean, I'm not keen on this one because the facts have changed. I think the most recent trading update was something like 14% negative like-for-like. Well, when you're geared up on a 75-80% gross margin, that does really serious damage to your P&L. And you also have to think with this one, it's actually, they license the brand name from the US. So they have to give, I think it's 3 or 4% of revenues in the royalty fee for using the name. Well, again, in a consumer downturn, that's the last thing you want, isn't it? So that adds another layer of gearing to the operational performance. And I just came to the conclusion that the forecasts for 2023, calendar 23, are just far too optimistic, I think. And it's got bank debt. You see, I'm generally averse to bank debt even in the good times, but I think in times like this, I'm really trying hard to avoid anything with bank debt that could become a problem. So unfortunately, I did have to let my Hostmore go. It's been a complete disaster. But nobody predicted the economy was going to tank and there was going to be a war in the Ukraine. You can't beat yourself up when the circumstances have completely changed.
I think the king is just to like you and I, you just accept these things happen and adjust your portfolio accordingly. You've decided to sell out and move your funds somewhere else. So that's that makes us as sensible as anything you can do, isn't it? Really, you just got to accept that things go wrong.
They do, and I think also in difficult macro conditions, you really see. What was it, the Buffett quote about who, when the tide goes out, who's wearing a bathing costume? And I think Fulham Shore, for example, another expanding restaurant chain, is doing much
Franco Manco, isn't it?
Yeah, they're doing much better, and they're expanding and opening lots of new sites. Well, that to me it really proves the point, which was probably covered up by all the government support measures a year or two ago. But actually, Fulham Shore is just a better format, and I mystery shop TGI Fridays all the time. And it's just not value for money. So they've introduced, it's too expensive, and they've the sodas are always flat, and that's been like that for a year.
My wife quite likes them flat. She doesn't like the physique. I'll have to tell her about to go down TGI's on Friday.
It's ideal for her then, yeah. But they're doing now, special offers for where a starter, chips, and a soda for a tenner. And a main and a side for £18. Well, that's telling you that people are just not prepared to pay full price. It's not a value for money offering. And when people tighten their belts, those are the businesses that get hit the hardest, I think.
Just coming to a couple of good sort of dividend payers, which are sort of a bit further up the food chain. Let's go for the house builder, MJ Gleeson, because I know you like this. It's an affordable sort of like house builder up in the northeast that does sort of like cheaper version houses for people who first-time buyers and this sort of stuff. It's paying about 5.5% dividend yield.
Yeah, I mean, I think you flagged up the house builders when we spoke before we started doing this. And I think it's a great sector to look at. All the obvious things about, people are probably, house prices may dip. Mortgages are now 6.5% for a 5-year fix. Well, who in their right mind would take out a 5-year fix? I think you look at a 2-year tracker discounted deal now. I think you'll see a complete shift in what type of mortgages. Yes, they're higher risk, but they're much more. They're still comfortably affordable. And And the thing that really struck me with Gleeson is that the average selling price, and this is for brand new houses, not apartments, all houses, 127 grand.
It's amazing, isn't it?
It's stunning. Now, you go on Trustpilot and you can see where they make the savings. I mean, basically, these things just seem to be thrown up, and there are numerous complaints about them. But what the hell do people expect for 127? And they're only paying about 9 grand per plot for the sites.
Yeah.
They even boast that a couple, both earning minimum wage, can afford to buy one of these. So that's going to be recession-proof, isn't it? I would have thought. So that's,
and I think it's trading at last time I saw it was £3.80, and its net tangible book is at least £4.50.
Well, that's the thing. That's the thing. These house builders now, it's different to all the previous cycles where they normally almost go bust, don't they, in recessions? This time they're all sitting on net cash, plus all the inventories and so on. These things have got bulletproof balance sheets. Redrow is amazingly cheap, although maybe they're a bit higher up in terms of the product price. But I think all the house builders look so cheap. But you can't really value them on PE or dividend yields, given the uncertainty. But I think certainly they're copper bottomed in terms of asset value, because of course all the land and all the work in progress is on the balance sheet at cost.
No, you're right. I mean, and also you've got people like my kids who are 25, 26. They're qualified accountants. They're earning decent salaries, looking to buy their first home. Yeah. But in the next couple of years, well, why not buy the shares of a house builder at a 20% discount to the price you buy your house, just to give you a hedge for when you do, then you then sell the shares in 2 or 3 years' time. So if the house prices go down, yes, your shares will go down. But if the house prices go up, or even just normal mean, you've made yourself a quick 20-30% profit there to mean reversion.
Yeah, exactly. Good point. And a lot of the statistics on this are very, very interesting. People say, the multiple to average salaries is 5-6 times. It's double what it was historically. But the point is, people on average salaries are not the people who are buying houses. They can't afford to. They rent. The people who are buying houses, actually more than half of owner-occupier houses now, don't have a mortgage at all.
Yeah. And
the people who are buying them probably are getting a big cash bung from the bank of mum and dad or their grandparents. It's a shame that it's like that, but we're not comparing apples with pears, I think.
Apples with apples. Yeah, and I think the other thing to note is even though you've got your mortgage rates at 6.5% at the moment, they haven't yet readjusted to what the swap rate is because the way they price a lot of the mortgages, the banks and the lenders, is off the interest rate swap futures, and what that is saying, because of what Rishi Sunak and the new Chancellor have done, then that has reduced the cost of the borrowing by 1% or even 1.5% over the last 2 or 3 weeks. It just hasn't yet come through. There's always a delay. It's like anything. It's like interest rate. There's always a delay before that thing it feeds through into actual mortgage rates. So you will see the mortgage rate reducing significantly below 6% for 4 to 2 years and 5-year deals. It's just a matter of time. If you just look at the actual what's happening, on the coalface, how they actually price these things.
No, that's very interesting. Thanks, Paul. I didn't know that, but
yeah. Another one, I think, just the final one, which was S3, a recruiter that you've had a good look at, I think.
Yeah,
and it does sort of engineering and technology recruitment around the world, and it's still knocking the ball out the park in a tight labour market.
It is. STEM is the ticker, and that also is a description of what they do: science, technology, engineering, is it, and mathematics.
That's engineering, yeah.
One of these acronyms. Well, yeah. Again, I've been really impressed with the trading updates that I've been reporting on in the small cap value reports throughout this year and part of last year as well. The CEO is a German chap. He seems to be very good at executing, I think. And so I invited him to do an interview with me, and it sounds really good, because what they're basically saying is their markets, are almost certainly going to remain strong, and it's actually it's a staffing business, so it's recurring revenues really, because then they don't do much in terms of permanent recruitment. It's mainly he gave the example of a wind farm site in Holland may want a particular type of engineer. for a year or 18 months. They book them through STEM, and there's good margins on it. And so STEM then has this 18-month flow of pretty much guaranteed. So it's got good visibility, good margins, good visibility, great balance sheet, sitting on pots of net cash, paying out nice divvies. So, and it's only on a PE of about 9. And there's probably not going to be a significant recession in that type of labour market because there's such a chronic shortage. I think he said there's about 5 million shortage of qualified IT and engineering people in America alone. And S3 has got, I don't hold any personally, but I think it's certainly on my long list of things I would like to buy if I suddenly managed to conjure up a couple of million quid from somewhere.
Now, I mean, the other thing which is quite interesting about S3, it's got a very good life sciences franchise. So not only is on the engineering, and let's be clear about it, every single health service, whether it's private or public, is screaming for sort of like, life sciences and doctors and all that kind of stuff. They don't do the doctors, but they do, in terms of the actual guys in labs and this sort of stuff. And that is just such a long-term secular tailwind that they're really strong in. And I think they've done brilliantly out of life sciences, which is it's quite a unique little part of their business.
Yeah, and I like the geographic spread as well. A lot of the business is Germany and surrounding countries. And a couple of my readers are experts in the staffing sector. I think they own companies in that area. And I've queried them, well, why is it that S3 makes such a good margin and a smaller competitor, Gattaca, it does so badly? It never seems to make any money. And we've had some quite interesting discussions about that. And my readers seem to think it's really down to having the rainmakers, if you like, the key recruitment consultants who know all the best clients, who have great relationships with the staff themselves, and those key people seem to stick around at S3, and Gattaca doesn't seem to be able to get hold of them. So that's interesting.
Yeah, well, I mean, and they're on a PE of about 9 and a 4.5% divvy yield, so they're a good value play with plenty of growth.
Yeah, plenty of cash as well. That's the other thing I like. A lot of staffing companies rely on quite a bit of bank debt. S3 is the opposite, is swimming in cash.
Yeah. Is there anything else notable that you own at all, Paul? You sort of like?
Well, I've got this thing. It's speculative. It's done really badly so far. Called Seraphine. Have you come across that?
Okay. Yeah. It's Bump is the.
Bump. Yeah, and that is alluding to it does maternity wear, all bespoke designs, but it also does. It's not just for pregnant ladies. It's for when they're breastfeeding as well. So, and then a lot of women have 2 children, obviously. So the life cycle of each client is actually about 5 or 6 years, and they're making very, very high gross margins, well into the 60s. It's online only, sells in Europe, UK, and America roughly in equal proportion. But nobody's interested in the market cap. It was one of these things that floated, at a bonkers valuation. And it just grinds down every day with hardly any trades in it. So it's only 9 million market cap.
Wow.
I think that's my biggest holding at the moment. So, I think it's one of these things that I'll just have to, just pray basically.
I've heard a few smart people talk about it as well. That they're looking at it. So I don't think you're the only one who's having her. I think you're probably picking a very good moment to build up a position, actually. I hope
so. I mean, the CFO recently joined with the former CFO at French Connection, so he knows what he's doing. Obviously, he steered that through a very turbulent path, and it was one of the last men standing when it was sold. And I've spoken to the CEO at Seraphine, and he seems to know what he's doing. Oh, and there was a big direct to buy. The CEO spent about £250,000 buying stock.
Oh, wow. Okay.
Which is a big vote of,
confidence.
And that was at a higher price than the moment. But it has got a bit of bank debts. And it's one of these companies that leaves a great long gap between the trading updates. So in these yawning gaps, you end up having kittens and imagining that everything must be falling apart. So I just don't know. We'll have to see.
You'll have to get married to have a to mystery shop that one.
Oh, well, I got my niece to mystery shop it.
Did you? Okay, right, fine.
I sent her 200 quid in vouchers and said, buy whatever you like on Seraphine and let me know what it's like. And they bought a couple of gilets, which have like a zippable pouch.
Okay.
So the baby, if their child's been born now, you hold it in a sling, on your chest. And then this really nice gilet has a little extending bit to keep the baby warm.
Oh, okay.
They said they're brilliant. Absolutely
Brilliant.
love them.
Yeah, well, they should hopefully do pretty well at Christmas. Now, just finally, in terms of, obviously you've got massive expertise in retail and leisure and all that kind of stuff. Now,
Hasn't done me much good.
well, the thing is, it's a sort of broader picture really for investors, or a broader point sort of stuff. Is it, if you're not careful, you just got to be aware that you don't get sort of lopsided into one sector, even though it looks hugely attractive on valuation. Because if you're not careful, your portfolio can get very heavy in one area. And if for some reason you are wrong in that area, then it gives you a real problem.
No, you're exactly right, Paul. I can't argue with any of that. I think you made that point in one of the talks we had earlier this year, and you were spot on. Spot on. So unfortunately for me this year, it's been a terrible year because, you know, the stuff that my sector specialism, if you like, is retail and online retail. That's been hit the hardest within a bear market that's been brutal for all small caps. So I was just in the wrong place at the wrong time, and that's the way it goes sometimes. But we live to fight another day, and we'll get the money back in the next bull market. So
I would agree. Hopefully 2023 we'll have a good sort of rally in small caps, and we'll both be smiling this time next year heading into Christmas.
Hope so. Yeah.
All right. Well, thanks very much, Paul, and look forward again in touching base in 6 months' time.
Absolutely. Thanks, Paul.
So.